Hey, thanks for joining us, everybody. So, one hot topic that we often come across here at IND involves a certain very prolific financial influencer, Dave Ramsey. It's no secret. And he's very vocal about one of the primary assets that we hold dear here at IND. And he has a lot of objections. And a while ago, our very own Jason Kenyon, welcome, Jason and Barry, by the way.
Thank
Hey,
you.
Steve.
Jason wrote an article, a very in-depth article, actually, Jason, responding to Mr. Ramsey and a lot of these claims. So we want to do that. We want to be factual. This isn't because our egos are offended or anything like that. We want to really look at these claims. We want to look at why maybe, Dave is the way he is, and respond with, an honest look, and maybe encourage you guys watching to look a little deeper as well. Jason, let's hear it. What do you think about a lot of these objections? Maybe we can walk through it.
Yeah, so what I plan to do here is just go through this article claim by claim. These are all claims made by Dave Ramsey about whole life insurance, and so we're going to see if any of them hold water. Let's just dive right into this. So the first one here is it's a scam. So Dave likes to call infinite banking and whole life insurance a scam.
Right.
That's a little rough because when I think of scams, I'm thinking of a Nigerian email or maybe Bernie Madoff. Some sort of a scam to me connotes that this is not legitimate. And yet whole life insurance has been around a lot longer than most of the financial things that Dave Ramsey talks about.
Right.
Barry, would you like to address this? I know you have a strong opinion on if infinite banking is a scam or not.
Yeah. And we'll start at the root with whole life insurance. Obviously, infinite banking is designed with a properly structured whole life policy, but it can't be a scam. And the reason it can't be a scam is because there's guaranteed returns that a person's earning inside of a policy's cash value. So it's really peculiar that Dave would use this blanket statement and call whole life insurance or infinite banking a scam when internally we have a contractual guarantee from a mutual insurance company that's been around 120 plus years, 170 plus years in some cases, and they also pay dividends. So it's interesting, guarantee doesn't equal scam. And I've had clients pass away. Family members have received death benefits. If it were a scam, these insurance companies wouldn't be paying out millions of dollars of death benefit. So it's definitely a sad way to describe whole life insurance. To call it a scam, it's completely inaccurate.
Well, Barry, now you've got my attention. I think we want to. Do we want to dive into this a little deeper? In other words, what about this? First of all, Dave seems to think that people that help people set up policies and whatnot, like yourself and like our whole team here, that they're somehow inherently evil. He seems to make that allegation in not so many words. What is he getting at? Does he think sales tactics are underhanded? Does he just think this is a bad deal? Why would he go as far as he does to say it's a scam? Do we think that his opinion's compromised somehow? How can we dig into this?
Yeah, he always talks about the cost of insurance, right? So you're going to pay a lot less premium for a term insurance policy than you will a whole life policy if we're talking about equal death benefit amounts. And Dave wants you to go invest in the stock market. But what's interesting is if we define scam as uncertainty, there's no predictability, you might lose something, well, we've just defined the stock market. Yet Dave is telling people to put money in the stock market. And we're not saying don't ever invest in the stock market, but the definition of scam more defines the stock market than it ever would whole life insurance that's guaranteed and predictable and pays out death benefit claims. But
Well,
we
when you
know
think,
Dave wants.
excuse me, Barry, I was just going to throw in there, if you want to talk about scam, we can talk about accounting principles of WorldCom or Enron. I mean, there's plenty of scams that are in the stock market as well that can wipe you out. And when I was a younger boy and traded penny stocks, there were plenty of scams. So to say that whole life insurance, which has stood the test of time, is a scam is a huge stretch on Dave's part.
Yeah, and
Right. I mean, it's one thing to say it's a bad deal, right, guys? It's an entirely other thing to suggest that people are literally conning the public into something like this. And I think that's where I think there's a lot of overstepping. But what were you going to say, Barry?
well, to use that word, it's such a strong word. So far from the true purpose of whole life insurance. So Dave likes to shop, right? He's a financial entertainer, and that's what he does. He's going to use words that sound big and robust and sound, interesting, kind of like clickbait for people to be like, oh, scam, I want to click on that, what it's about. But for him to
Right.
say it and put it into motion, it's harmful. You can't use blanket statements to cover an
Right.
entire industry, nor can you use blanket statements to think that one size fits all. So Dave will say, invest in term insurance that has a lower premium and put the remaining portion of your money into the stock market. But what Dave fails to talk about is true stock market volatility, fees that are hidden in market investments. He also doesn't talk much about what happens when your term insurance policy expires, right? If you've had a 20 or 30-year term insurance policy and all that money goes down the drain because you outlived the policy, that's not a scam, but it sure feels more like a scam if there's nothing to show for it at the end of the day and you've paid premiums for 20 or 30 years. So again, term insurance is great to have, but for Dave to say that whole life insurance is a scam, I've always wanted to ask Dave this question. Dave, why do banks, major corporations, and wealthy people invest in whole life insurance? I would just love to hear his answer to that question.
Right. Look at the balance sheets, look at the financials of these companies and see how much whole life is actually there. So Barry, what are the statistics on term? So, because that's a major point that you touched on. There's a very small percentage of term policies that are ever cashed in despite the premiums. And there's a completely reverse statistic for whole life insurance. When you have that contract, when you've paid it in full or in however you choose to do that, you're going to eventually collect that death benefit, which you mentioned.
Yeah, let me answer your question this way. This is very telling. So Steve, Jason, if I came to you and I said, hey, I've got two opportunities for you. The first opportunity, you're going to be able to see a benefit where 90+% of the time you win. Or option two is less than 2% of the time do ever people win. You'd say, well, I want the one that's 90+%. That's whole life insurance. Less than 2% of term insurance ever pays a death benefit. And that's because 98+% of people outlive their term coverage.
Right, guys, do you really think, and this is for discussion, do you think Dave has looked at this? Do you think he understands whole life insurance in general, that he's taken a careful he proclaims that to be a math guy, and I actually believe that about him, that he's probably good at math in some respects. This is a tough one for me too, because some of the things that he talks about I agree with, which I'm sure a lot of people do. He says some things that are helpful. So then how did he come across whole life insurance one day and completely fall off the wagon on this issue? Do you think it's willful? I mean, do we think maybe it's just an error in judgment?
Yeah, I don't know if he's had a bad experience or a family member. I don't know anything about those details. I would guess he's looked at a traditional whole life policy where cash value doesn't grow that rapidly. And he's saying, look, I can get you more death benefit coverage and the premium is going to be less. That's probably what he's done. But he takes that one example and uses these things as a blanket idea or statement over everything. And that's just not fair, right? Because you can't say that something good for me is bad for someone else or something bad for me is good for someone else. We don't know. Everyone has different financial situations. And that's how things should be analyzed. But unfortunately, Dave is very blanket statement oriented when he gives advice, and it can be extremely harmful. I've seen it. I've seen his advice harm people, and we don't want that.
Well, I've seen a lot of Dave's advice, so to speak, about whole life insurance, and I assume that, well, he says, whole life insurance is old school done poorly. Old school done poorly. So, Dave Ramsey, in an asset-based economy and telling everyone to get out of debt, even though inflation is out of control and crippling us with our money supply, Dave Ramsey is telling people to pay down their house, their mortgage, pay off all their credit cards, which is fantastic, but stay out of debt completely. And so a lot of his principles, a lot of his personal finance advice is circa 1960, 1950. So maybe he's stuck in that old school mentality himself.
It doesn't seem like a maybe. Jason, you mentioned that, I think it's ironic. You mentioned that he talks about, old school done poorly. I think that he recognizes old school because he is old school. And, his old school ideal would work well for, a baby boomer like 40 years ago. And I think that's a viable criticism that I've heard a lot of, is that he's stuck, and we know the advice well, right? Invest in the S&P, pay off your house. Those are great. To me, those are great baby boomer pieces of advice if you were living at that time when that advice was hot, right? And I think maybe is he stuck in the past there? I love Dave's story. He talks about his financial collapse in real estate very vulnerably. So in a way, I feel like he's going back there. He's going to go back and correct that by giving advice that would have worked well at that time. Just observation, but
I'm recalling a quote similar to what you've just said, where Davis said, "Infinite banking is whole life done poorly," which reminds me of something else that Grant Cardone said. If you want to live in the middle, if you want to live mediocre financially, you take Dave Ramsey's advice. And Grant's like, look, I don't want to live in the middle. I don't want to be mediocre. I don't want to be the sandwich, right? I want to be out there making things happen, generating wealth, generating income, cash flow. So Dave does have some good things that he says and teaches about people getting out of debt, but he should not be telling people don't ever invest in whole life insurance. Don't sell a whole life policy. Don't own a whole life policy. Because look, when people get into retirement and their term insurance goes away and there's no more family death benefit for your spouse, for your kids, or for your grandkids, believe me, you're going to feel the pain of that. When you become a grandparent, you're going to want to leave legacy to your children. And guess what? If you have $1 million 401k and you pass that on to grandkids, you're going to leave them $1 million. You would have paid dollar for dollar for that $1 million portfolio. But if you put the same amount of money in a whole life insurance policy, you could leave them 2, 3, 4, 5 million. Because whole life insurance death benefit is always going to give you more than what you put into the policy, especially if you start a policy in your 20s, 30s, or 40s, maybe even early 50s. So we've got to be thinking about, what do we want? What do we want our future to be? Because if you want mediocre, if you want to be in the middle, take all of Dave's advice, don't ever get a whole life policy. And you'll suffer the consequences of that decision.
So, Barry, Dave Ramsey says infinite banking is just traditional whole life insurance. That's what he says. So, how would you address that question? Like, can you help everyone watching this? What's the difference between traditional whole life insurance and these high cash value whole life insurance policies that are designed for infinite banking?
And I'm smiling, Jason, because this is one of my favorite top 3 topics, right? Traditional whole life insurance is focused on death benefit, and 100% of the first year premium is commission for most agents. Okay, you put all the money into a policy, and that's going towards the commission, and you don't have any cash value. What we're talking about with an infinite banking designed whole life policy is most of your premium going to cash value. The focus is not death benefit. And what's so remarkable is the whole life policy for infinite banking has a term insurance rider built into it. Just like Dave says, get term insurance. Well, guess what, Dave? We're adding term insurance to whole life to make the whole life more robust, to raise what's called the MEC limit, and allow the majority of the premium to go to cash. If you put, let's say, $24,000 a year into a whole life policy, and $20,000 of that goes to cash value, you've got a very low death benefit, and 90% of your premiums going straight into cash. That's a very low commission product. In that example, commissions are being reduced by 75 to 85%. And the main difference, high cash value, we use paid up additions, we use a term rider, we minimize death benefit, and maximize the amount of cash that a person has to be their own bank so that they can use the policy for the infinite banking concept.
I've never heard Dave mention any of those things, Barry. I'm trying to rack my brain. I wish that would be an amazing thing to have the chance to chat with Dave and just ask him, are you aware that the agents that do infinite banking, they actually take a huge commission cut in order to do it? I wonder if that would resonate with him. It's funny. We're in the world of, I haven't heard Dave comment on some of Kiyosaki's ideas in the arena of buying assets. We're, per Jason's comment, we're in an inflationary environment where the people at the end of the day that aren't obliterized by inflation will be the ones that got their hands on some assets, whether they be, per Dave's recommendations, some real estate, whether they be, a policy, which is a contractual asset. I love to talk about 7702, the tax code, which I've never heard Dave mention that either. Whether he doesn't know about it or just chooses to ignore any feedback. I mean, that code provision, it protects the nature of cash value in a life insurance policy and gives it special tax treatment. Anybody listening, so Barry, as an estate planner in my background, trust attorney, Jason has that background as well. It propelled us into this arena. We are very much with you on the boilerplate, blanket statement, advice kinds of things. It's just so destructive to have a visceral reaction and overreact and say never do this or that, right? And then to actually take it one step higher and call it a scam.
So, Steve, let me address that real quick. One thing about Dave Ramsey that does get annoying is his one-size-fits-all advice. I remember someone called one time, and before they could, explain the situation to Dave, Dave was already handing out advice. I think the guy said like a couple sentences. And Dave immediately knew the answer to what this guy should be doing with his money. The problem with that is everybody's different. I have whole life insurance. I invest in stocks. I invest in real estate when opportunities arise. I invest in Bitcoin. I invest in my own business. I use whole life insurance in a different way than Dave Ramsey would even understand. it's an asset as a foundational asset that allows me to purchase other assets. And I make compound interest in my whole life insurance policy while I'm investing in these other assets. So it's a amazing asset to funnel a lot of my income into, and then using my income that's in my policy that now has a leveraged death benefit to purchase more assets.
You are speaking the language of exactly what the wealthy do. The wealthy leverage assets, and they usually leverage assets tax-free. Like how amazing is that? Have you ever heard Dave Ramsey say, "Hey, I don't like whole life insurance, but did you know you can take policy loans tax-free and go buy other assets?" No, you'll never hear him say that. But the fact of the matter is, as you're building up cash value in the policy, it's equity. It's equity that you can loan against to go buy other assets 100% tax-free. Who doesn't
All right.
want that?
That's powerful stuff. Barry, what would you say to somebody, or Jason, great points, guys, that would say, well, this is great for super rich people? Because I've heard this one. And also there's this idea like, permanent coverage is maybe important for somebody that's got estate tax problems. That's the other one. Well, if you have a huge estate, you need some liquidity, maybe it's okay, which to me is completely inconsistent. So in other words, you get this compounding asset that you can set up for yourself. To me, it's no different than if you try to pay your mortgage off. You're just trying to create value down the road for yourself, right? But what do we say to somebody that says, well, I'm not super rich, it doesn't work for me? And if there's super rich people listening, you need the other side of it. You need to know that, hey, this isn't just so you can get some liquidity at death. You can actually storehouse capital and diversify by using this asset. So there's different things going on, right?
Yeah, and we like to work with the rich and the super rich. But those that aren't rich or super rich, look, I've done this for 25 years. I have clients all over the country, and some of my clients are putting in $700, $800, $1,000 a month into a policy. Takes some time to build up some things, but it can still work. We also have clients that are putting in $500,000 plus into policies and $1 million or more. So it works for anyone that has discretionary income and wants three primary things: to grow money guaranteed, to have access to cash, and three, use that money 100% tax-free. Most of you listening out there, you probably have 401ks, IRAs, brokerage accounts, but let me ask you the question. Which of your investments right now are growing, guaranteed, they're 100% liquid, and 100% tax-free? Most of you are going to say, I don't have anything that meets that criteria, especially in one product. We're saying that's possible. And in most cases, I should say a lot of cases, we're outperforming stock market returns anyway because of the guarantees and dividends and predictability. But as you look at your own life and the goals that you have, most of you want tax-free, most of you want guarantees, but very few of you have those benefits in your financial portfolio.
Let's dive into this next one real quick if we can, guys. Cash value dies with you. So you get a policy, you fund it, put money into your life insurance, build up cash value your whole life, and when that day comes, you die, and the life insurance company keeps all your cash value. Is that true?
I'm just getting a picture of Dave right now. He's just like, what? He's doing that, and he does that about policy loans too. You're borrowing your own money. He's tripping about this stuff, and he's trying to like gaslight people with it. So that's a gaslighter right there, Jason. Right? I mean, you're going to lose all your cash value. Those evil insurance companies are just going to take it because they're just evil and they can do that. I mean, it just doesn't make sense. But How
Yeah.
do what happens to the cash value? Maybe Barry, you want to address that one.
So maybe in traditional whole life, but overall, no, especially in these proper design policies. So I have in front of me, okay, I've got some numbers here. I ran an illustration for a 36-year-old female living in the state of Tennessee. And this 36-year-old female is putting $24,000 a year into a policy. The first year whole life portion that she's purchasing is $194,000 of death benefit. But guess what? Her first year death benefit is $652,000. You think, well, if she's purchasing $194,000 of whole life, how in the world is she getting $652,000? It's because of the term rider that I mentioned. Now check this out. If she passed away in 10 years, remember she only purchased $194,000 of whole life insurance. Her cash value in 10 years is $292,000. If you add 292 to 194, let's just round it out and call it $500,000. Well, guess what her death benefit is that year? $1.3 million. So Dave is completely wrong. Her family would get $800,000 more. Now let's go out, say, to age 61, 25 years from now. Cash value is $1.18 million. If we add the $194,000 that she purchased originally, we'll round it up and call it $1.4 million. Cash value plus original death benefit. But guess what her total death benefit to her family would be? $2.53 million. So Dave, how is it that the life insurance company is keeping cash value? And I can go year after year after year. In all cases, her family would get much more than the original death benefit paid for plus the cash value.
So,
And that's because this is a properly structured policy with a growing death benefit. Dave doesn't mention that. Dave doesn't mention that whole life insurance, traditional or new style for infinite banking, both types of policies have a growing death benefit. At least
right,
with
and
the company
essentially,
that I write with. Yeah.
that cash value is funding the death benefit.
To grow more rapidly. Now, we only work with the top mutual insurance companies in the industry. So I'm speaking about companies that I write business with. Maybe there are other insurance companies out there where it's not as favorable, which is the case. We're talking about companies that we work with, that I have experience with. And in all cases, your family would get more than cash value.
I'm glad you're bringing that up, Barry. So these are products, right? There are going to be companies that they don't have as good of, one company may not have as good of a product as the other.
Yeah.
And as an agent, you really do have an ethical duty to explain the products. So, and I think that if Dave were ever going to take a valid position on this stuff, he could say, well, some of the sales tactics maybe are, whatever, sketchy for some people. You're kind of like throwing the baby out with the bathwater because you have a few bad apples, and it's in any area really, right? We could nitpick Dave's industry, we could nitpick lawyers, we could nitpick virtually anybody, bankers. There's always people that want to take liberties and not do things right. So what you're saying is that you vet companies, we vet companies as a company, and are committed to doing things right. Why? Because we like to sleep at night. One thing that bothers me about a lot of these criticisms, you have a lot of good people doing good things,
Yeah.
and they're getting lumped into this category. And it's sad. Everybody wants to take a shot at someone these days, and I think that does happen, in this process.
Yeah. Steve, let me address one more thing because I want to get some of this illustration kind of off my mind. This 36-year-old female living in Tennessee funded the policy through the age of 64.
Barry, I don't want to interrupt you, but isn't Dave in Tennessee? This isn't a family member or anything.
Could be a family member. Yeah.
Yeah.
Yeah. So she's done funding the policy at age 64. No more premium going in. But at age 65 and beyond, her cash value and death benefits still continue to grow. Okay. No more premiums going in. Still getting cash value growth, still getting death benefit growth. statistically, if she's healthy today, she's going to live till she's 87. This is a life insurance mortality table, right? Life expectancy. At the age of 87, okay, she would have put in a total of 592,000. That's her contribution up through the age of 64. At age 87, her cash value is $4.7 million. If we add the 4.7 plus the original 194 in whole life that she purchased, let's round that up to 4.9 million, right? What would her family get? Her family would get 5.56 million, 100% tax free. Obviously, there's some estate things in there we'd have to talk about. But as we're looking at the numbers today, 590,000 of premium turns into 5.56 at the age of 87. It's a permanent death benefit, right? It's whole life insurance. The term insurance eventually goes away. You never see that on this particular design. But had she had term insurance, that death benefit would have gone away in 20 or 30 years. We're talking 5.56 million on a $592,000 premium. Her family's taken care of. Permanent death benefit, whether she passes away at 87 or 107, there's always a permanent death benefit, and she stopped funding at age 64.
And Barry, this is the point when people in the comments or what have you are going to say, well, what is her return on investment or rate of return? And this is the part that will make you crazy, because no one's taking into account infinite banking. So the policy is amazing. If you want to just sit on this policy and get your internal rate of return, which 5% or what have you, that's fantastic, especially when you consider there's no taxes. So what's 5.25% or something if you're taxed? 7.5%, whatever, depending on your tax bracket. 8. So, but that is whatever. So you're getting 8% in your policy if you're considering taxes versus a taxed account like a 401k. But then what about infinite banking? Why is it always return on investment is X? What if I'm sticking more money into this policy because I have more capability, and not only am I putting more money into the policy, so I have higher volume, right? Like a bank's loaning out all their money, so they're making volumes on their small little interest that they're charging people, but it's volume. Volume is so much more important than rate of return. And so now I have volume in my policy, but I'm not letting it sit there. I'm going to practice infinite banking because that's kind of the point. So now I bought a real estate property in that timeline, or a couple. I bought some investments. I saw some good opportunities. Bitcoin dropped, whatever. And now I'm also getting the return on those assets, maybe using that cash flow to pay back my policy. But I'm doing stuff. I'm not just sitting in a whole life policy for the rest of my life earning 5%, which isn't bad, like we just went over, because that's 8% if you consider taxes. But I'm not doing that. I'm actually getting a rate of return on my money. I can take 10% of my whole life policy if I'm putting volume in and put it in the stock market. Now I got 10% in the stock market like anybody else, plus I got a whole life policy that's going to pay out this gigantic death benefit.
And Jason, you're still earning interest and dividends on your total cash value. Remember, when you take a policy loan, the insurance company doesn't physically remove that money. You still earn interest and dividends on your total cash. So me as a 17-year real estate investor, I take policy loans for the down payment on my real estate. And I'm getting double-digit cash-on-cash returns in my real estate, plus I'm still earning 5% tax-free in my policy, and I'm compounding on my total cash value, even though I have a loan. We're talking stacks of multiple benefits here. Dave doesn't ever address any of this. One, I don't think that he knows, but if he did, I think he would be much more kind relative to people using whole life insurance, purchasing whole life insurance. But Dave is approaching whole life insurance like a 5-year-old. It's very naive. It's very, as we've talked about, blanket statement oriented and harmful.
Well, let's blast one more of these real quick here. So with a policy design, Can you explain the flexibility or the lack of flexibility, right? Like it's whole life insurance. If you don't pay your premium, the policy's going to lapse. What are we looking at here?
Yeah. So on this illustration that I put together for this 36-year-old female in Tennessee, her premium is $24,000 a year. Her minimum premium is $4,100 a year. So in any year, year 2, year 30, she could reduce down to $4,100 a year, or any amount in between $4,100 and $24,000. It's a flexible premium. So if there were ever a financial hardship, she's not locking into paying $24,000 a year for the rest of her life. And this is a properly structured policy. In traditional whole life, this is the issue with traditional old style whole life, is you are stuck with the premium payment until you pass away, in most cases. But in the type of policies that we design at Insurance and Estates, flexible premium, you can go lower at any time. You can fund the minimum, the maximum, any amount in between. We even have clients that are doing first year lump sums. They're dumping in a 50 grand lump sum, a 100,000 lump sum, a $500,000 lump sum. So flexibility is key. I often will tell my clients on our Zoom calls, if there's anything you remember from our 30-minute appointment today, remember the word flexibility, because that's going to help you sleep well at night, knowing that you're not locking into paying a premium your entire life. And as I mentioned here, for this 36-year-old female in Tennessee, she stopped funding at age 64. No more premiums going in after that. Yet her cash value still continued to grow, and so did her death benefit.
Excellent.
Yeah. And I also want to confirm that she's an example, and we're not representing in any way that she's related to Dave or any member of his family. Just a lawyer in me.
Well,
Good disclaimer. Thank you.
But Steve, you bring
confusion.
And you bring up another good point. You bring up another good point, because these policies are designed for you as an individual, right? This 36-year-old female, it may not be fitting your financial criteria or portfolio. You might be a 50-year-old and you might want to dump $50,000 a year into a policy. You might be a 30-year-old that wants to dump $100,000 a year into a policy. Or you might be a 60-year-old that just wants to put in $500, $600, $800 a month and see what you can do. So everything that I do for clients, it's all personalized. This is hands-on. I design the illustrations for every single one of my clients. I don't defer that to a member of my team. I always do illustration design myself, because I want to make sure that clients are getting the best policy, the best company, and the highest cash value possible, if that's their goal.
So I'm gonna say that we, in one way or another, have gone through all these, and I'll include this article with the down below in the YouTube description. I want to touch on something though. So I have policies for each of my children, and I use those policies in with financial literacy to teach my kids how to do this themselves, and then have them pass that on to their own children. So I'm already in the works with this. I have investing books. I have books on real estate. There's multiple avenues that I can teach my children with these policies about how to get ahead of interest, get out in front of interest. Nelson Nash in his book said the typical person pays 35% interest throughout their lifetime. I believe that's what he said. Instead of being the person paying interest, I'm teaching my children to capitalize and to receive the interest.
Yeah.
Yeah, I mean that seems to go along with a lifetime of financial peace. Hey, there's one more objection. There's one more objection that I watched. It seemed like Dave's head was going to explode. And you guys touched on policy loans a lot. He tried to gaslight again on the issue of borrowing he said you're borrowing your own money. How can you be charged to borrow your own money? a lot of this, the stuff that you guys talked about, you talked about the return, about the option to buy other assets. If you use policy loans tax free, uh, that's that's obviously a powerful thing. You're not borrowing your own money. So I just thought I would mention that. Do you guys want to comment on that as far as policy loans, how they work, what they are? I've always found that one of
Yeah,
those objections.
it's an inaccurate statement. I mean, again, Dave is talking about whole life insurance like a 5-year-old. It's just an inaccurate statement. When you take a policy loan, you're borrowing the insurance company's money from their general account. The reason they charge you interest on the loan is because they have to take money out of their general account that they were earning interest on and give it to you. They don't physically remove that money from your cash value. That's another sign that you didn't borrow your own money. You're still earning interest and dividends on your total cash value. So if you have $100,000 cash value and you take a $75,000 loan, that loan came from the insurance company. The interest you pay on that loan, which is around 5%, goes back to the insurance company. But you are still earning interest and dividends on your total 100,000. And when we do side-by-side comparisons, when you pay down a loan, it's principal reduction. You're paying less interest over time. But your policy cash value, it's still compounding. So if you're earning 5% and paying 5% at face value, we could say, well, it's a wash. No, it's better than that. You still come out ahead because of the compounding versus the principal reduction.
Right. And Dave is very opposed to debt as a sort of another blanket kind of thing. But when we look at these policy loans, they're literally the best of all worlds when it comes to borrowing anything. I mean, first of all, like you said, you're paying down your principal, you're getting charged interest on the average daily balance. So they're very forgiving, and they don't require repayment because they're basically there's a mechanism inside of the policy that allows reduction in death benefit if you have outstanding loans. So they're very discretionary loans. So this is not the world of banking that most people are thinking about when they're thinking about borrowing money.
Yeah, and we want people to pay their loans back for sure, but it's not required. The insurance company doesn't ask, what are you using the money for? They're not asking for a huge application for you to fill out, and there's no credit check. These are private loans. They don't show up on your credit. So as an investor, or if you're out there buying a bunch of real estate, these are private loans, and it's not going to affect your credit when you're out there trying to acquire more assets. In my 25-year career in helping clients all over the country, I personally have never seen an asset that does so many things at the same time. And if any of you can find something that does, please share it with me. But like Jason and Steve, I'm investing in crypto, real estate, gold and silver, my own business, stock market, got a brokerage account with some stocks. But what I don't have are government qualified plans. I want to be in control. One of the rules of the wealthy is to be in control. One of the rules of the wealthy is to minimize tax. So these policies provide a lot of financial principles that you're not getting in other places, generally speaking. You're not getting guarantees in your 401k or your IRA. You're not getting tax-free in your 401k or your IRA. And you're usually not getting liquidity in your 401k or IRA. Because if you try taking money out of those before 59 and a half and physically withdraw the money, you'll not only pay the tax, you're also going to get hit with a 10% early withdrawal penalty. There's none of that in a cash value policy. So we're talking guarantees, liquidity, tax-free, permanent death benefit, and there are 10 other things we could talk about that we don't have time for today. Read the Insurance and Estates articles, but this is an asset that will bless you and your family for generations if you'll take it seriously and don't buy in to all of the financial entertainer information out there, because a lot of it simply is not true.
Absolutely.
Well
Do your own
said, Barry.
research.
Well said. Do your own research. Look at these policies for yourself. Look at how the numbers work. Look at all the ways that they can be used. You know, there are a lot of things in our world right now that could be categorized as scams. We're coming to this with integrity and can say this isn't one of them. You know, the originator of the 401k, Ted Benna, is quoted as saying that he would scrap the model, start over. So this is something that I was watching an episode not too long ago of Dave's, and somebody called and said they'd saved $1 million in a 401k, which is great. You know, everybody like lost it. They were celebrating for the guy and backslapping and all kinds of locker room stuff. And yet it is what it is. You know, everybody's being coached. This is the way to do it with these 401ks. I personally observed as a planner that they're very cumbersome. If somebody dies with one, they're very cumbersome and complicated to mess with. So anyway, a lot of great points today, guys. A lot of things
Hey,
to consider.
Steve, question. Would you rather have $1 million in a whole life insurance policy or in a 401k?
I think that's a great question, Jason. There's zero thought process for me to answer. Absolutely the high cash value whole life. Complete discretion, complete liquidity, complete leverageability. Did you mean that I have $1 million in cash value, or that that's my death benefit? That would be my other question, but it wouldn't really matter. I'd rather have the policy either way. But I figure if I've got $1 million in the policy, that means I probably have $3 million in death benefits. Awesome, guys. In closing, encourage you guys watching, take every possible avenue to financial peace and consider it carefully. With that, thanks so much, guys, for contributing. Thanks for watching. If you're new, check out our other videos. We got a lot of example videos that we put together. Subscribe, like, all that stuff.